studying your last two. I swim med when I turned in. The staring down to mute. And can learn a pole that some kid died.
For many years, Canadian corporations had a relatively simple refundable tax system. Whenever a corporation paid refundable tax on certain types of investment income, that refundable tax was recorded in one single account known as the Refundable Dividend Tax on Hand, or RDTOH account. Everything was kept together in one place. When the corporation later paid taxable dividends to its shareholders, it could generally recover refundable tax from that single account. While the system worked, it also created opportunities that were not always consistent with the government's intended tax policy. As Canada's corporate tax rules evolved, the government decided that a single refundable tax account no longer provided enough precision. To improve the system, the rules were changed. Instead of tracking all refundable tax in one account, the original RDTOH account was divided into two separate refundable tax pools. The first pool is called Eligible Refundable Dividend Tax on Hand, or ERDTOH. The second pool is called Non-Eligible Refundable Dividend Tax on Hand, or NERDTOH. Think of this change as replacing one large storage vault with two smaller vaults, each designed to hold a different category of refundable tax. The purpose of this change was not simply to create more paperwork. Instead, it was designed to better match refundable tax with the appropriate type of dividend that would eventually be paid to shareholders. In other words, the government wanted a closer connection between the source of refundable tax and the type of dividend that could trigger its recovery. At this stage, you don't need to memorize exactly which amounts go into each account. The important concept is much simpler. The old system had one refundable tax account. The new system has two separate refundable tax accounts. From now on, corporations may have balances in both ERDTOH and NERDTOH instead of maintaining just a single RDTOH balance. This means that tax preparers must pay closer attention when reviewing corporate tax returns, because there is no longer just one refundable tax account to monitor. The key takeaway from this slide is straightforward. Canada replaced the single RDTOH account with two separate refundable tax pools, ERDTOH and NERDTOH. This change allows refundable tax to be tracked more accurately and forms the foundation for the dividend planning rules that we'll examine in the next slides. Understanding this structural change is the first step toward understanding why corporate dividend planning has become more sophisticated under the current Canadian tax system. Now that we've seen that the original RDTOH account has been divided into two separate pools, the next question is, what is the difference between ERDTOH and NERDTOH? The easiest way to understand these accounts is to remember that each one is connected to a different type of dividend. The first account is called Eligible Refundable Dividend Tax on Hand, or ERDTOH. As the name suggests, this account is associated with eligible dividends. When a corporation has a balance in its ERDTOH account, that balance is generally intended to be recovered through the payment of eligible dividends, subject to the applicable tax rules. The second account is called Non-Eligible Refundable Dividend Tax on Hand, or NERDTOH. This account is associated with non-eligible dividends. It separately tracks refundable tax that is linked to this different category of dividends. Think of these two accounts as two separate storage vaults. One vault stores refundable tax connected with eligible dividends. The other stores refundable tax connected with non-eligible dividends. Although both vaults contain refundable tax, they are kept separate because they serve different purposes within Canada's corporate tax integration system. This separation allows the tax rules to more closely match the type of dividend being paid with the refundable tax that can be recovered. At this point, you don't need to memorize exactly which transactions increase each account or the detailed legislative ordering rules. The important concept is much simpler. There are now two independent refundable tax balances, not one. Each balance is maintained separately. Each follows its own refund rules, and each is connected to a different category of dividends. A helpful way to remember this is with a simple association. ERDTOH goes with eligible dividends. NERDTOH goes with non-eligible dividends. If you can remember those two relationships, you've already understood the most important concept in this section. The detailed calculations will become much easier because you'll already know why the two accounts exist. As a tax preparer, you'll now review both refundable tax pools instead of looking at a single RDTOH balance. Understanding which account contains refundable tax is an important part of reviewing a corporate tax return and preparing for future dividend planning. The key takeaway from this slide is simple. ERDTOH and NERDTOH are two separate refundable tax accounts. Each maintains its own balance and is linked to a different type of dividend. Understanding this separation is essential because it determines how refundable tax may eventually be recovered when dividends are paid to shareholders. As we've seen, Canada's refundable tax system now contains two separate refundable tax pools instead of one. That change may seem small at first, but it has a significant impact on corporate tax planning. Under the old system, a corporation simply needed to determine whether it wanted to pay a taxable dividend. Once the dividend was paid, the refundable tax mechanism generally followed a straightforward path. Today, there is an additional decision. The corporation must determine which type of dividend should be paid. Should it distribute an eligible dividend, or should it distribute a non-eligible dividend? This decision is important because each type of dividend is connected to a different refundable tax pool. If the corporation has a balance in its ERDTOH account, paying the appropriate type of dividend may allow it to recover refundable tax from that account. If the corporation instead has refundable tax sitting in its NERDTOH account, the dividend strategy may be different because that refund is linked to a different pool. Think of it like standing at a fork in the road. One road leads toward the ERDTOH account. The other leads toward the NERDTOH account. Choosing the correct path determines which refundable tax balance can potentially be recovered. This is why corporate dividend planning has become much more strategic than it was under the old system. A tax preparer can no longer recommend dividends based only on available profits or cash flow. They must also review the corporation's refundable tax accounts and understand how the proposed dividend will interact with each one. Before recommending a dividend, several questions should be considered. Does the corporation currently have an ERDTOH balance? Does it have a NERDTOH balance? Which type of dividend is appropriate? And which choice allows the corporation to recover refundable tax in the most efficient manner while remaining compliant with the tax rules? Fortunately, professional tax software keeps track of both refundable tax accounts and performs the necessary calculations automatically. However, software only performs calculations. Professional judgment is still required to decide which dividend strategy best fits the corporation's circumstances. That is why understanding the concepts behind ERDTOH and NERDTOH is so important. The software may calculate the numbers, but the tax preparer is responsible for interpreting those numbers and making informed planning recommendations. The key takeaway from this slide is simple. The introduction of ERDTOH and NERDTOH means that dividend planning is no longer just about paying a dividend. It is about choosing the right type of dividend so that refundable tax can be recovered from the appropriate account. Understanding these two refundable tax pools allows tax preparers to make better planning decisions, improve corporate cash flow, and ensure the corporation benefits fully from Canada's corporate tax integration system.